Well, it's been a minute since I've done a video, and there's multiple reasons why that is. It seems like people are more interested in talking about stocks that really don't have any strong fundamentals, but it's going to make everybody rich. Everybody wants to buy into the AI hype while it's already expensive. But there was multiple sectors that I thought were generational buying opportunities, and I brought them to your attention. I brought up companies like Bristol Myers Squibb, Pfizer, Gilead Science. Almost all of biotech and healthcare were trading at decade lows with tremendous opportunities ahead. With all the advancements in technology, are you telling me that these companies are not going to find opportunities and cures that we never thought of? Welcome back in, investors. So today we're going to talk about sectors that were being overlooked, that were generational buying opportunities, and what is still available out on the market that could be a good deal. If you're new to compounding capital, welcome in. We take a fundamental approach on this channel. My name is Colton. So let's get into the opportunities presenting themselves. If we take a 1-year snapshot of all sectors, it's pretty clear to see that there has been a few laggers here. Real estate being number one, consumer staples, discretionary. But one I want to kind of point out here is going to be healthcare. And we talked a lot about the United States having to refinance a tremendous amount of commercial real estate, the unknown about commercial real estate. And so there was multiple headwinds and still multiple headwinds going into the end of this year for commercial real estate. And I do think there's going to be a buying opportunity for commercial real estate. So instead of looking at commercial real estate, to me, the obvious was healthcare. Now, healthcare has defensive earnings, so no matter if we go into recession or not, as we saw before when the world was at its worst, what did we need? We needed healthcare. And we were talking about quality companies trading at multi-decade lows, yielding over 5% and 6% in some cases. And while everybody was jumping on all the other stocks, on this channel, we really took a fundamental approach and saw that healthcare was a tremendous opportunity. Now, I want to highlight Gilead Science, ticker symbol GILD. This is now a massive outperformer in my portfolio as it went from $63 a share and shot up to over $70 a share. Now, if you were able to buy this at $63 a share, you were getting over a 5% dividend yield, which was more than what the 10-year treasury was offering. So what has been taking place is there's been multiple companies that we've talked about, whether it's HPE, Cisco Systems, Pfizer, that have been making acquisitions that are getting overlooked by the market. And I want to stay on healthcare really quick because healthcare has been getting absolutely punished, but the fundamentals are actually starting to get stronger. We watched companies like Pfizer pretty much throw a kitchen sink awful quarter at us, but now is starting to guide for over $2 a share of earnings, which means it's trading right around 11 times earnings while yielding a 6% dividend yield. They recently made the acquisition of Seagen, so if you're buying Pfizer at these levels, you're basically getting companies like Seagen for absolutely free. And whatever comes from that pipeline is obviously going to grow earnings down the road. Now, this is not a 1 to 2 year process. This is probably more of your 3 to 10 year type of investment. Same thing with Cisco Systems acquiring Splunk. So what was the great news that catapulted Gilead Science? Now, I want to make it clear that these types of companies are going to be extremely volatile, but you want to buy them when they are extremely cheap. If we go through the last few years of Gilead Science and take a look at enterprise value, it basically trades between 115 billion and 120 billion of enterprise value. And where are we today? It was trading below 100 billion not that long ago. Now, this recent rally has pushed it over 100 billion, but you're basically buying at historically low valuations. And when we look at the forward PE trading at 17 times, yes, this seems a little expensive, but when we look at the company's valuation overall, we're buying it at extremely cheap valuations on an enterprise basis. Now, I personally don't recommend buying Gilead at these levels, not after this run-up. I would try to get it back in the 60s or even possibly high 50s. I think it's an absolute gem at these levels. I think you get a strong dividend yield, and I think you get a tremendous amount of opportunity when we talk about oncology. But what recently happened with Gilead Science is that they discovered a twice yearly shot that has proven 100% efficiencies for prevention of HIV. So with these biotech companies, this is why you don't want to write calls against these biotech companies, especially when they're trading at depressed valuations, because a company like Pfizer could absolutely get into the weight loss drugs and it could skyrocket the stock 10-15% intraday, and then you get the position called on you. But Pfizer could legitimately be back to a $35-40 stock price, and you've captured a very small piece of this. So with these biotech companies, especially like a Gilead Science, You want to buy them cheap, you want to hold them long term, and you want to understand what's in their pipeline. Most people think of utilities as kind of just a safe bet and where you're going to get a yield. And in my opinion, I think when we look longer term and the whole AI thesis and population growth and us becoming more reliant on the grid, utilities are going to have a top line revenue growth and earnings growth that could be a long-term story. Currently trading at 27 times earnings and forward earnings probably sitting closer to 23 to 25 times earnings. It's definitely getting into frothy territory when we look at the valuations, but there's still deep value in here, and I pointed it out when we start looking at healthcare, consumer staples, and other sectors. Now we definitely could start digging into technology sectors, but I think we have to look at more of your legacy, deep value type names that, once again, maybe he's been making good acquisitions or has some sort of reacceleration of growth ahead. So just to recap, I think that we've seen one of the most unbelievable opportunities when it comes to investing in healthcare. I also believe that some of these high flyers are not going to be the true AI winners. When we think about the tech boom, I want you guys to take a look at what happened to Microsoft. Microsoft was just trading between a $20 to $30 stock and eventually became a massive player with investments and acquisitions that it's made. And I think the same thing could be said true with what is going on with the AI landscape right now. Everybody's buying overvalued hype stocks when really it could be those underperformers that are deep value plays that have good balance sheets, making good acquisitions that really could be the long-term winners in the AI game. As always, appreciate your time, and we will see you in the next one.